Yeah, so what we're going to do tonight is mostly bonds, but I'm putting in a little bit of stock on it as well. Those are the two major investments that you will find in mutual funds. I've got a financial planner coming in here next week. He's going to cover all of mutual fund investment. So you need to have a basic idea of how bonds work and a basic idea of how stocks work in terms of what they are and how you work out rates of return. So if you look at your notes there, we're going to look at bond characteristics. So a bond, the first thing you want to note is it doesn't give you ownership. It's a debt instrument. So if you have a corporate bond, they actually owe you money, but you don't own any of the corporation. You're just simply lending them money. Or if you get a Government of Canada bond, you're lending the Canadian government money. You don't own it. Okay? So it's debt and it's not ownership. Okay? It's usually a series of interest payments to pay you back, and they're usually made every 6 months. Not always. Some bonds are every 3 months, but normally every 6 months. So if I had to draw a picture of it, you're putting money in here for 10 to 20 years. At the end of that period of time, they'll pay you back the money. If it's the same amount of money here at either end, it's called at par. And as well as doing that, they're going to give you a series of payments. Even one at the end here, a bit odd. And those typically occur every 6 months. So I put my money in here, I buy the bond. I get two types of return. I get a series of interest payments every 6 months, maybe for 20 years, and I get a payback on the principal over here. And if these two amounts are the same, it's called at par. Okay? Typically a bond comes, it's a piece of paper, and it has a face value on it. So there's an amount of money stated on it. You'll find with bonds, later on we'll look at it, you don't necessarily pay this. Initially, probably you're going to pay that. But later on, when you sell it to somebody else or they buy it, they may pay you more, they may pay you less. Okay? Please note as well that you have a contract when you buy a bond. So they can't change that contract. Okay? You've bought it here. They're even going to state a certain interest rate, an amount of money, and so on. They cannot change that. That stays the same for all of those years, even though you may have 4 or 5 different owners during that period of time. The term of a bond, this is unlike what we heard about when we looked at mortgages. The term is the entire period. So the term could be 20 years, 10 years, and so on. The term is right to the end of when the maturity happens, when they pay you back this money. That's the term of the bond. Now, those of you who have financial calculators or have cell phones for tonight, set up your phones or your financial calculators with these buttons, the financial keys, because we can use those to figure out values of bonds. Because the maturity value, what they pay you back, will be the future value. N will be the number of payments that they have. So over 20 years, every 6 months would be 40 payments. 1 over Y is the interest rate every 6 months. PMT is the payment amount that you're actually getting. And you'll find present value is the value of the bond. Okay? And we'll try a couple of problems like that. Now, bonds come in all kinds of different types and with all kinds of different features. But what we'll try doing is talking about what are the major features that we have. Well, the first one that we can talk about is called a debenture, and I'll spell that for you. A debenture, that means an unsecured bond. So when a company has a debenture, it's a bond where they don't actually list assets or anything else. They just give you the company name, Ford Motor Corporation. That's it. And you'll find that that's different than other companies. For instance, there are such things as mortgage bonds where they sell you the bond and then there's literally a mortgage and all the assets of that company backing the bond. Okay? We can also have a call feature, C-A-L-L, call feature. What's a call feature? The company has the right to pay you back before maturity. So remember I talked about, we did the deal, here's the contract, I lent you the money for 20 years, maybe 7, 8 years into that, they decide they're going to pay you out. Okay, and now they've listed that they can do that and how they would pay you out. Okay, but that's called a call feature. That gives them the right to pay you out early. A convertible bond. That's a bond where you get to cash the bond in and get company stock at a certain price. So that might be a nice feature for you, 10, 15 years into the bond, to be able to what? Convert it into actual stock of the company. If stock values went up in the company and you already had a fixed lower price, that would certainly be a good thing for you. Okay, and that's a convertible bond. You can convert it into company stock. An extendable bond. Extendable. I better write that one up too for you. An extendable bond. This is where the investor gets to move the maturity date a little bit further out. So instead of being 20 years, they can call up and say, I want it to be 25 years. They're extending the maturity date. So that's an extendable bond. A put feature, so just put P-U-T, a put feature bond. Here the investor can redeem the bond before maturity. So maybe you have bought a bond that's 20 years out, it's maturing in 20 years, and you decide you want to get paid before that. So it's not the company saying that, it's the investor. You have a right to say, I want to get back my amount that I lent you 5 years early. If we turn over the page, we want to look at what are called discounts or premiums on a bond. And to do this, we're going to use your calculators. I'm going to get you to do some problems. So let me draw up a really simple bond. where you're putting money in. They're going to pay you back $1,000 at maturity. So this is maturity. The interest rate is J2 equals 10%. So what country am I in if it's J2 equals 10%? We'll have a hint. What country are we in right now? So we're in Canada. We're compounding semi-annually. We're not rip-off Americans. What would I tell you if I put this in? Good thing your wife's not here. That's monthly compounding, and you'd know you're what? You're in the States, right? Remember that? Okay, so it's J2 equals 10%. Well, that helps us out because I'm going to tell you that the payments here are every 6 months. And I'm going to tell you that it's 10 years. So here's your first little bit of math. How many payments are there? If it's every 6 months, is that twice a year? How many years? 2 times 10 is 20, right? There's going to be 20 payments on the bond. If it's at 10%, how much do they have to pay you back in a year in terms of interest? $10 times 1,000 is what? Is $100. But instead of 100 once a year, they pay you 50 every 6 months. Would that make sense to you? Now, there's another way you can figure that out. Take the 10, divide it by 2. Is that 5%? 5% of 1,000, is that 50 bucks? Is that okay? Because you know that it's 5% interest every 6 months or 10% annually. Are we okay with that? Okay, now I'm going to impress you with a disgusting formula. And no, you won't need to know this for the exam. But I expect to see that all over town, right? So if I go to a bar, I expect to see that it's written all over the walls. And I'm trying to impress people. We've actually done this. This is present value of a future amount, and this is the annuity flow present value. Now, rather than doing that, I'm going to get you to use these keys, which you can get on your phone. Or your financial calculator. Okay, so what I want you to do now, tell me how much you should pay here for this annuity, and we'll do it together, because I know it's your first time. Okay, how much should we pay for that bond? Okay, what do you think the payment should be? You okay? How many payments are there? 20. You told me before. What's the rate of return, the interest rate for every 6 months? 5%. What's the future value that they pay you back? We okay there? And what do I need to find out? The present value. What is it worth today? So you tell me. But you're going to need to go compute present value. Go ahead and have a try. See what number you get. Oh, you haven't got a phone? Oh,
No,
okay.
I do, but my calculator doesn't do it.
Doesn't have a calculator on it, okay.
Well, it does, but it's not fancy like that.
Did anybody get $1,000?
Is there a different key that you need for the, you got the 5?
You may have to get into the financial mode.
Because I'm pretty close there, but I don't see.
What number did you get?
I don't have that one key there. I've got. Or is it just, would it be I?
Sometimes you might get negative 1,000 here because of its logic. It's putting in positive at one end, negative at the other. Okay. So look for present value of a bond. Just write that in, see if it has it. See, what it's doing is it's giving you an annual rate of 10%, and you need one that breaks it down into a rate for 6 months. Yeah. Okay, now, notice that the bond, they pay back 1,000. The present value is 1,000. So that means that this is at par. Remember that expression? At par means you're getting back what you put in. That's the present value. I want you to do the same problem. But I want you to put in a different interest rate. Notice that this is J2 at 10%. Let's say the market rate went to 6% or 3% every 6 months. Give me the value. So do the same problem, but you're now using 3%. If you think about it, if the bond is at 10% and this here in annual terms is 6%, is the bond a good deal? Yeah, it is. If the market rate is 6% and your bond is paying you 10%, that's a good deal. And so the number that you should be getting at the bottom here is 1297.55. Can you see you're paying way more than $1,000 for that bond? We say that you are paying a premium. Why are you paying a premium? Because the market rate is 6%. Remember, 6 divided by 2 is 3. So that bond is a really good deal. In the financial market, it's 6%, and your bond pays 10%. So that's why you're paying more than the face amount. You're paying a premium. Remember, they can't change the bond contract, but what changes is what you pay. How did you do on your calculator this time?
Yeah, I got it.
You're okay?
97.54.
And how about you? Any help?
Yeah, no,
Can't do her?
I didn't catch the numbers, so
But I'm just, okay. I don't know if I follow what I've done though.
Oh. Okay, now what I'm going to do is I'm going to change the rate again. I'm going to tell you that interest rates have gone to 20%. If interest rates have gone to 20%, what am I writing in here? What's the interest rate for 6 months? 10. 20 divided by 2, isn't it? So work out what that bond is worth now. Did anybody get an answer of 574.32? In other words, that's a discount. Why are people paying so much less for the bond? Because the market's at 20%, the bond only pays 10%. The bond is a rotten deal. Its interest rate is half that of the market. So how do we make up for that? We pay less than the face amount. We have a discount on the bond. Can everybody follow that? Very key for tonight. So here's the deal. When interest rates go up, what happens to the value of bonds? They go down. When interest rates fall, remember when it was only 3%? What happened to the value of the bond? They go up. They work opposite, don't they? Can you understand the idea? Is everybody okay? So if you bought into a bond, what you'd love to see is that interest rates go down, you're making big money. What you don't want to see when you buy a bond is interest rates later on do what? Go up. What happens to the value of your bond? Goes down.
So, what for buying bonds? Generally speaking, are you buying them for the interest payment, or you want to sell them later on?
You're buying them for two things. One, the payment that they will give me back, the maturity payment 20 years from now, or 5 years from now, whatever it is, and the payments I get every 6 months. This, if it's an analogy that helps, I'll give it to you. I buy a warehouse, what am I getting a return on? The lease payments, and then 20 years from now, I'll sell the warehouse. It's the same kind of investment. So a bond is I lend my money to a company, I buy the bond, they pay me interest every 6 months, and at the conclusion of the term, they pay me back what I lent them. They can't change that contract, but we now know what changes what. This thing can be bought. I can come in here and buy it here, here, or here from somebody else. And what changes the bond value is the market rate. Because its interest rate is fixed, it goes up or down in value, the present value, depending on where market rates are.
So on this equation here, the 10, 1 over y, or is there a percentage sign there?
This,
That's the market rate.
that's where we're putting in the market rate.
Okay, because we have our
We've already got the payments, and they can't, that $50, they got to pay it for the full 20 years. They can't change that. And that was determined by what? The bond interest rate. So you buy the bond, and it states it right on the piece of paper. This is the interest rate. This is how much it is that you're borrowing from you. Are we okay? So the contract cannot change. What changes? The value of the bond. We can't change anything else, but the value of the bond changes. Can I take this off now? If you figured that out, you guys are doing really well. You're getting into about third-year commerce finance course. So there's your compliment for the night. That means you're all nerds. Okay, next. Who are bond issuers? So who are the people that try to borrow money from you? Who issues these bonds? Okay, well, the government of Canada issues bonds. So the government issues bonds, it borrows money, and right now it's borrowing billions of dollars. Okay? We say that's a riskless investment. Can anybody tell me why? Absolutely. They'll never go bankrupt. What will they do? They'll just print more money. They'll always pay you back because they got a printing press. And remember, we learned that money's not backed by gold, so they can just keep printing and printing. Federal crown corporations borrow money. So there are crown corporations in Canada that borrow money from investors. I'm writing down the names of 3 of them. This is Federal Business Development Bank. It borrows money from people and re-lends it to businesses. Farm Credit, they issue bonds, okay, and they lend the money to who? To farmers. CMHC actually issues bonds, and it lends money to people on apartments or real estate developers, that kind of thing, usually for social housing. Okay? So why would the government do this? Because if you think about it, the federal government backs all 3 of these. So investors, again, are quite willing to lend these outfits money, and that gives farmers a very cheap source of finance. Because in essence, the federal government is what? Backing the bonds that Farm Credit issues. Where an individual farmer, if it was, Joe Smith from Valley View trying to borrow on the international bond market, good luck. Whether it's a Farm Credit, that's different. They're able to go in there and borrow, $1 billion, $2 billion, or whatever. Okay, so they issue bonds. Provincial governments have bond issues. And in fact, all of them are running big deficits. We do in Alberta. You can buy Alberta government bonds. They're not riskless because the provincial government can't do what? Can't print money. At least so far they haven't been able to. So they're not riskless. We have municipal bonds. Typically, if a municipality, City of Montreal, is going to do some big freeway project or whatever, it may issue bonds specifically for that project, $200-300 million. Again, that's not riskless. And we have corporate bonds. So these are bonds that are issued by corporations. You might have heard the term junk bonds, J-U-N-K. All that means is bonds of medium-sized companies. It sounds awful that, it's out of the garbage dump or something. No, it's relatively small companies, but in our terms, we think they're fairly big, and they're borrowing bonds. So it's called junk bonds. It's medium-sized company versus big companies like General Motors and so on. Okay, T-bills, very important for tonight's discussion. T-bills, also known as treasury bills, are short-term government debt. They're less than a year. They're issued by the federal government. And most of them are 90 to 180 days. Okay? You don't get paid interest when you buy a T-bill. How you make money is you pay a discounted price. So what I'm going to do is give you an example of that. Here's a 90-day T-bill. You get $1,000 90 days from now from the federal government, and you paid $990 for it. How much money did you make? Can you see you made $10? Is that okay? And you made $10 on an investment of $990. We okay on that? I think that works out. You guys can work that out. I think that's the rate of return that you make. But there's a problem with me stating that it's 1.01%. Remember, rates of return are always in terms of a year. How many 90-day periods are there in a year? 4. So I multiply that by 4. Your rate of return is actually 0.0404. 4.04%. You okay with that? Let's see you guys try it. Tell me if you were able to buy the T-bill for $980. Tell me the rate of return. I'm going to take a gamble and see if you guys can figure it out. Is that what it was? 2.02%? Am I right?
I got 204. Oh, because one.
Did you get a 4 here?
Yeah, at the end, because 980 instead of 990.
Good. You caught a mistake. That's probably the first one I've made in 10 years. Okay, but I've still got to take it further. What else do I have to do? Multiply it by 4. Is it 8.16%? Can you see how it works? Now, normally, we won't go into it tonight, but the Bank of Canada rate, which is the rate that the Bank of Canada lends to the chartered banks at, and affects kind of loan rates for the whole country, is actually partially based on this. Not totally, but partially. The yield on the T-bill. I need you to note as well, this is riskless for the same reason you told me before, which is what? The federal government will always pay you back, because even if it had no cash, it would simply print it. We okay? So it's a riskless investment. Can I tell you that it's the base rate of all interest rates in our economy? So it's short term, it's riskless, it's the base interest rate for the whole economy, and it's the base because it has 0 risk. It has 0 risk. There'd never be a what?
For a T-bill for $1,000?
Yeah.
Because what would be the point?
10,000, 20, just different amounts.
Yeah, but.
Typically, you're going to be 100,000.
Okay.
Yeah.
Because I was going to say, like, goodbye.
Yeah, no, you could get into the T-bill market.
No, but I'm saying, like, what would be the point? Like,
Well, they'd borrow $1,000 from you.
Yeah, but then you're not getting paid interest.
No, but if you bought 100 T-bills, that's 100,000. I don't really know, but I'm assuming I wouldn't think it's so bad if you had a $1,000 T-bill. You might be right that it's 100,000. Say again?
I think you're saying that you wouldn't buy it for $4,000. Like you always have to pay less than they're going to pay you at the end.
But, like,
Typically, and there's an auction. So in Toronto, and the biggest people who play the market are the big banks, there's an auction. So it's supply and demand. And the price that's paid is not determined by the government, it's determined by the market. So market participants would decide what that's worth to them to buy.
Okay, but my question is, say I went and did exactly what we just wrote down, why would I do that?
You probably couldn't get in just for one T-bill at 1,000. But you probably could go to a broker and buy T-bills if you wanted. If you were interested in that as an investment.
Right.
But the return is so small at 1,000, you really wouldn't.
It's not that bad a return. That's a lot better than I'm making on my bank account.
Yeah, but it'd be more worth it doing in volume rather than small.
Yeah, they're doing volumes.
Right.
Yeah.
Yeah,
Okay, turn the page. Bankers' acceptances. When people trade between countries, big companies, they may be shipping products to another country and they want to make sure they're going to get paid by the company in the other country. So they get that company to go to a big international bank and agree to back it. That I know I'll get 5 million from some company in France. I'm doing that because Credit Agricole, which is a very big French bank, will back that. So by doing that, they've now created a financial instrument, a debt that's guaranteed by a big bank. And people buy and sell these. What are they called? Bankers' acceptances. So bankers' acceptances are corporate debt that grows out of trade. We have a bank in Canada called HSBC. It's very big internationally. It would do that for you. Commercial paper. Major companies such as HFC, Household Finance, Husky, Ford Credit, they will issue short-term bonds that you can buy. How do they guarantee those? They put the debt that they create as a guarantee of that. So you're buying that paper from them. It's called commercial paper. What's the guarantee? Well, Ford Credit is extending credit to thousands of people that are buying cars. And so all that paper backs the money that Ford, the debt instrument that it's selling to you. Okay? And that's called commercial paper. So that's another type of debt instrument, a type of bond that people invest in. Canada Savings Bonds. These are bonds that were issued by the federal government. They only were for 10 years. You could redeem them at any time. In other words, maturity was open on them. You can no longer get them. I think the last year was 2017. They won't issue them anymore. I remember them because most places in town, the bigger employers, had big campaigns by the personnel departments to sell you Canada Savings Bonds off your paycheck, okay, which they no longer do. Mortgage-backed securities, okay? So these are sold by banks and they're backed by pooled mortgages. So I'm the Bank of Montreal. I've lent billions of dollars on mortgages on households. They're all CMHC insured. Remember last when we took the class? That means they're all guaranteed in case of foreclosure by CMHC, which is the federal government. So here again, we have a riskless investment. BMO can issue bonds backed by the collateral is what? All the money they've lent out. That's a mortgage-backed bond. A stripped bond. Now, you don't get this anymore, but I'm going to explain to you what it is. Remember that problem we did? Where there were $50 payments every 6 months? And the face amount was $1,000. So an old-fashioned bond would look like that. And you could rip these off. They were coupons. And so you'd see the little old lady who was a widow standing in line at the bank, and she'd take the coupon off and turn it in and get $50. Okay? So then someone in the financial community got very bright and they said, let's take this and split the investment. So you can buy the coupon separately, or you can buy a strip bond. If you're buying a strip bond, what are you buying? Only that maturity amount 20 years from now. That's what you're selling. So someone will discount it to get a rate of return out of it. The person buying this, they're buying that flow of payments over 20 years. That's what they're buying. So that's a stripped bond. A real return bond. A real return bond. This is issued by the federal government. It gives you a return that is above the inflation rate. By changing the maturity value or the payments, the coupon payments. So let me explain that. One of the great problems we have now coming out of COVID, and boy, I hope somehow we're coming out of it, is that we'll be in debt up to our eyeballs, and on top of it, our interest rates are a joke. They're so low. I mean, we were talking, was it mortgage rates of 2%? Honestly, I never thought. If you had told me that about 1981, I would have had a heart attack and died here, because I was lending money at 19%. Okay? So one of the problems we have is if you went out and bought a bond right now, and say it was $40,000, and it was at 5%. In a way, that looks like a good deal right now. Okay? But what would you do if I told you, because of all the money they've printed, next year's inflation rate will be 30%? Can you see that would be a joke rate of return? In terms of a real rate of return, it's a bit more complicated, the formula, but that's like negative 25%. Negative. You would really lose money, and you now know the bond formula. What would happen to the value of the bond? It would tank. You'd really be in trouble. Okay? And that's what investors are really worried about right now. With all this money being printed, that we're going to have an incredible inflation rate. Okay? So this type of bond might be a really good thing. Because what's it saying? It's saying that if the inflation rate changes, and the government has the inflation rate, they're going to change either this or this. So in other words, the government could do this. Would you be okay? You might be okay. Can you understand why? Because they're giving you a real return above the inflation rate. They might change this because money will be worth a lot less at 30% inflation. So at the other end, we have to do what? Pay you more to make up for it. Can everyone understand the idea? So this might be a good way to go if you're really worried about that, is a real return bond. Okay, now I need to show you a graph, and we've really already done it, so you will understand this. And I'm going to look at return or interest rates over here, time here, and I'm going to tell you that this is the coupon rate. And you now know that the coupon rate, the interest rate on the bond, does not change. They're not allowed to change it. Remember J2, 10%, 20 years, they had to fix it. But you also know that market rates do what? They're changing all the time, depending on what's happening in the economy. So when the market rate goes up and the coupon rate is fixed, what happens to the value of the bond? Goes down. Remember that? There's a discount. When the market rate goes down, what happens to the value of the bond? Goes up, there's a premium. We okay on that? So you understand that? And you worked out the math for that, remember? We did that. Now, we need to note this for bond investment. When you make interest on your payments, in taxes, that's treated as interest income. Is that good or bad? It's bad. Interest income is 100%. They'll take it all. They'll add it in. So you're making these interest income every 6 months. They're going to give you a piece of paper saying this year we paid you whatever, and you're going to have to report it on your taxes. Is that okay? But you also know that there's a maturity value. Remember the amount they pay you back? I need you to note that's treated as capital gains.
What does that mean?
Okay. Capital gains are only taxed at 50%. So, can you remember at maturity they were supposed to pay you back $1,000? Let's say interest rates went down, things are really good for you, and your bond that you bought had gone up like this. Then you got into a period here, okay, and what would happen to you if you bought during this period? This period you'd pay a big price, wouldn't you? Is that right? This period you'd have a discount. So let's say you only paid $700 for the bond during this period. That's when you invested. Are you making a gain? You are. You just made $300. You only paid $700, but the bond matures at $1,000. You picked up $300. That's treated as a capital gain, and it's only 50%. It's not like interest income that's 100%. It's 50% what's called inclusion. So in actual fact, you're going to pay taxes on $150 even though you made $300. So that's a good deal for you. We okay on that? Tax-wise. Yeah. Now, let's look at when it's not a good deal. You bought your bond during this period. Interest rates were really low. The bond sold at a premium. You paid $1,300. Now you're only getting back $1,000. Is that negative? Now you've got a capital loss. Can you understand how we treat it tax-wise? So tax-wise, the payments that you receive, it's not good. It's 100%. You're going to be charged it every year. Okay? But at the end, on the maturity payback, there is an advantage because it's capital gains. And it's only a 50% inclusion rate. Can we understand that? So the maturity has an advantage to you tax-wise.
Can you buy bonds in your TFSA?
Say again?
Can you buy bonds in a tax-free savings account?
Yes.
Okay.
Yeah. Think of all those things that he talked about, RRSPs, RESPs, and TFSAs, as a box giving you certain tax advantages, but the investments in them can be whatever. For instance, I was naive. I heard the word tax-free savings account. Oh, I can only have a savings account in there that pays me interest. No, I can have a mutual fund in there that's all stocks. Okay? The TFSA is only the tax protection. Yeah. Okay, let's head over to the next page. Okay, we're going to talk about risks that you can have when you invest in bonds. And by the way, you can buy separate bonds. When you talk to the financial planner here a week from tonight, he will tell you you can buy bond mutual funds. A mutual fund that may have 30, 40 different bonds in it. But it's still, you need to have an understanding of how a bond works to understand how the mutual fund works. Yeah? Okay, the first risk we have is default risk. Default risk. Default risk. The risk that the issuer won't pay or they won't pay because they're bankrupt. So if you buy a corporate bond and that corporation goes bankrupt, there's probably a good likelihood you're not going to get paid on your bond. Now, you may get some money back through the receivers, but who knows? For the most part, governments don't have default risk. Why? Because the government can print money. So if it's government debt, Canadian government debt, they're not going to default because they have a printing press. Where you get in trouble, and we should note it, if the government borrows money in someone else's currency. Before your time, for most of you, I had a prime minister called Brian Mulroney, who told everybody that he would solve our debt problems after we had a crazy guy called Trudeau that put us into debt unbelievably, but not as bad as his son. I'm being political tonight. Mulroney did something even worse. He borrowed money not from Canadians, he borrowed it from other countries. So he borrowed in American dollars, he borrowed Deutschmark, he borrowed British pounds. Why is that a problem? Because you can no longer just print the money because the Canadian government can't print British pounds, US dollars, and Deutschmark. Can everybody follow? In fact, you have to work very hard as a country to earn the foreign currency to pay on the debt. A lot of third world countries borrow in US dollars. They're run by corrupt governments. They get into trouble. They can't service their foreign debt, and then they go into default. And that's where you get big problems in a country, because the IMF will come in and say, okay, fine, we'll bail you out, but you have to stop your bread subsidies, your fuel, whatever, and then there's enormous riots and fights. I went through one of these in Turkey. It was a hazelnut riot. North coast of Turkey, they produce hazelnuts. Turkish government had acted like idiots and lent all the farmers all kinds of money for nothing. They got into financial trouble. A lot of it, their debt was foreign. They needed to borrow money. They had to go to the IMF. The IMF had said, sure, we'll lend you more money, but you have to cut all your subsidies. Turkish government cut the subsidies to the hazelnut farmers. And I went through a city where they went wild. I think there were 3 guys dead. We were out on the freeway for 6 hours in a bus. I was watching armored cars going back and forth. Okay? So default typically doesn't happen on government debt unless the government has borrowed in foreign currency. Then you've got real trouble. Then they could default, right? Because they can't print the foreign currency. Typically, we say that government bonds are risk-free. For corporate bonds, there's a risk of default. Typically, the riskier the corporation, the more bond interest they have to pay you, right? When they issue a bond, they'll crank up the interest rates because it's risky. You should note there's 2 services you can go to, Moody's or Poor's. These are financial service companies. And if you were buying a corporate bond, you would go there and check out the credit worthiness of Ford Credit or whoever it was, right? You'd want to check it out before you lent them money. Second type of risk, call risk. Call risk. What's this risk? This is the risk that the issuer, the company that borrowed the money from you, will pay you back early. Remember, that was a call bond. They had that right. So, you thought you were in there for 20 years. No, they pay you back in 10. 3, inflation risk. Inflation risk, we just talked about it. You bought a bond, $40,000, remember it's 5%, and then you find out the inflation rate 6 months later is 30%. Well, in effective, your real rate of return is now minus 25%. You're in trouble. Right? So that's inflation risk, and it's very high right now. 4, this is one you're not going to understand, but don't worry about it. It's called reinvestment risk. When we do all these rates of return, one of our assumptions is that you can reinvest the money they paid you at the same rate of interest that they're paying you. So I get my $50 on my bond, and it was at 5%. If I'm working out the rate of return over 50 years, I have to assume that I can reinvest my $50 at 5%. If that's not occurring, it becomes a much more problematic thing to figure out the rate of return. That's called reinvestment risk, the risk that I can't get the same rate of return. And finally, number 5, interest rate risk. Interest rate risk. That is the risk that interest rates change in the bond market. You did those problems. When interest rates go up, what happens to the value of your bond? Goes down, right? That's the risk. You bought into the bond and interest rates in the bond market go up, well, your bond's worth less money now. It's not a risk going the other way, is it? That's happy times. Okay, bond investment strategies, there's 3 of them. 3 of them. First one is called interest rate strategy. Okay, so you're investing in the bond market. This is your strategy. If interest rates are going to go up, what happens to the value of bonds? So should you buy short-term bonds or long-term bonds?
Long term?
Short-term. Here's why. If it's short-term, I can go in and buy a bond that's maturing in less than a year. So I know there's 2 payments of $50, and I know they're going to pay me back $1,000. So if I screw up, interest rates go up, well, I'm out of it in a year. It's not so bad. Can you understand the idea? That's way better than this is going on, and I bought into a bond that's got 20 years on it. Now I'm really up the creek because I'm stuck in there for 20 years.
But interest rates will go up and down, right? So,
Maybe, maybe not.
right.
Okay, let me go the other way, see if it helps. Now this is projected, what you believe is going to happen. Interest rates are going to go down. So you're saying to yourself, interest rates are going to go down. What had happened to the value of bonds? So it's a good deal to buy a bond, isn't it? And that's when I buy what? That's when I buy long term.
So you're watching the market.
This, you're watching the market. You know that interest rates are going to go up. The value of bonds is going to drop. So you're buying short term. You don't want to be in there for a long time. Okay, which one is holding today? Which of those two? Can I tell you this is it? Our interest rates rock bottom. They only have one way to go. What's going to happen to the value of bonds? Going to go down. So if you're working for a big investment house, you're buying bonds that mature in a year, 6 months, 8 months. That's where you're playing it because you're worried. You don't want to get stuck with it. Can you understand? Yeah? Okay, so that's 1, interest rate strategy. 2, passive strategy. Passive strategy. What's passive mean? You're not doing anything. So passive strategy is you buy the bond and you sit on it for 20 years. It'll go up and down just like you said, and we'll just sit on it. We'll get the 20 years out of it. So that's the passive strategy. Next one, maturity matching strategy. Maturity matching strategy. So let me give you the classic example for financial planners. Guy shows up, I'm retiring. Then you look at the guy, talk it over, when did your dad die, what happened, blah, blah, blah. And you figure it out between the two of them, they're a married couple, that they're probably going to live till they're what? Is that about right? They're going to get 15 years in? We okay with that? I don't know what the death rate is now. I think guys are what, 82? Females might be 86. Okay? Now, when do you think retired people are the most active? When they have health. And when is that likely to happen? In here, isn't it? This is active. This is what you call the go-go years. So they're traveling all over the world. They're getting into health stuff. They're getting into a sailing boat or whatever the big deal is. You see them out on the highway on the motorbikes, all that kind of stuff. What's happening here? Not so active. I'm being nasty on myself. This is, sit in the house and drool at the window. Sorry. Okay? But I mean, you get to a point that you're not going to be doing stuff. Health, your body will start falling apart and you won't be up for it. Is that right? So when do you need money for your retirement? Do you need it in here? No, a lot less. I'm going to draw a smaller dollar sign. You might need double the money here to pay for your world traveling and all these exotic sports that you're going to be in and all the other stuff. All your dream stuff that you have on your bucket list, right? So this is the trip to Machu Picchu, right? Here, I need nothing like that. That's me living out in that building at Claremont. Yuck, I don't even think about it.
That can cost a lot of money.
Hmm?
That can cost quite a bit of money.
Well, compared to my trip to Machu Picchu, it's not going to cost much. Okay? Are we okay with that? Okay, so you're buying bonds. What type of bonds would you like to buy? Maybe a lot of bonds in here that would mature in the first 8 years, because that's when you want the money, and not so many bonds maturing here because you don't need the money. Can you understand the strategy? What have I done? I've matched the maturity to my need.
What did you call this strategy?
It's called the maturity matching strategy. Maturity matching strategy. So people are retiring, they're buying these bonds, and they're saying, when do I need the money? And you're matching that. You're saying to the guy, you really need it here because you're going to have a great active time. And here, I hate to tell you, you're probably going to do what? Maybe sit in the living room a lot more. We okay with that? Okay, now let's turn over the page. Now we're going over to stocks. So we're going to leave bonds, and we're going to talk about stocks. Okay. So this is the second basic type of thing that you're going to find in a mutual fund. You have typically 3 assets. Money market, which are short-term bonds. They're very short-term deposits in a bank that people have that pay interest. Bonds, we've talked about that. And now stocks. Stocks give you ownership of a firm. They give you ownership of a firm. They give you voting rights in a firm. So you get to vote, depending on the amount of stock you own and what's going on in the firm. Okay? And you get a share of the profits. Now, when a company makes profit, and you'll know this from accounting, some of you have taken it, does it necessarily give that to the stockholders? No. It can keep the money and use it for investment, and you'll look in the financial statements. That's called retained earnings. So it retains the money in the company, retains the earnings, and uses it for investment purposes. Or it can pay it to stockholders, and then we call it a what? A dividend. So if you're getting dividends from a company, you own stock in that company. And they've declared that they're going to pay you a dividend. When you buy a stock, you get a return of 2 types. 2 types of return. Every year you get dividend income. So you get dividends from the stock. And if you elect to sell the stock, you get that money. And if you're lucky, you're making a capital gain on it. You're selling it for more than you paid for it. So 2 types of return. The dividend and the sale of the stock. Here's the rate of return for a stock. I'm getting you to do this so you're going to impress Jerry next week with all you know. This is the rate of return on a stock, R. P is the price of the stock. And so here's the price of the stock at time t. Later on, this is the price of the stock at time t plus 1, one time period over. And this is D, and D, you know, is the dividend. So if I put some numbers into there, this will be plain to you. So if you look at those numbers, you bought a stock for $50. A year later, you sold it for $58. You were paid that year a dividend of $1. So you made $9 out of the $50 that you bought the stock with. 9 divided by 50 is 18%. We okay on that? Now, stocks are sold in two markets. The primary market, primary is a fancy word for first. Primary is when the stock is first issued by a company. We have an IPO. IPO stands for Initial Public Offering. So there's a big Chinese firm tried to have an IPO a week and a half ago called Ant, A-N-T, one of the world's biggest. Chinese company, government, I think, almost arrested the guy and shut it down. That was a big scandal in Hong Kong here a week ago. So that's a primary market when they come in through investment dealers and first issue a stock, IPO, Initial Public Offering. 2, a secondary market. Secondary market. If you like, used stocks that are already issued, are being sold to other people now. Because just like a bond, I can own a stock for 1 month, sell it. I can own it for 15 years, then sell it. Okay? So stocks are bought and sold continuously. Okay? A secondary market is the TSX, Toronto Stock Exchange. Or the what? The New York Stock Exchange or the London Stock Exchange. They're selling stocks continuously on those exchanges. I think they're closed overnight, but there's trading all day. Okay? You go from London to New York to Tokyo and back to London. So it just keeps going around. Okay, types of stocks. Number 1, we have dividend stocks. Dividend stocks. This is the stock of older established companies. This is the stock of older established companies that pay dividends every year. Okay, so do you think the TD Bank pays a dividend every year? Yes, it does. Please note, this is the kind of stock that a retired person would like. It's probably low risk, it's an established company, and 2, what do retired people need? Income. So they're getting dividend income. They would like dividend stocks. That's different than the second type of stock, which is a growth stock. This is the stock of a newer company. It probably pays low or no dividends. But uses the money for retained earnings. So instead of paying the dividend, they keep the money in retained earnings and use it for investment. So the early years of Apple didn't pay any dividends, kept all the money, and kept reinvesting it and growing the company. It was a growth stock, called growth because typically, because they keep investing it again and again and again, the company grows, and therefore the value of the stock does what? It grows. So you're not getting dividends, but you're getting, hopefully, a growing value to the stock. Is this good for a retired person? No. Who's it good for? Younger people. So if you've got a client that's about 30 years old, maybe to 50, that's what they should own. Because they're buying stock with a mind maybe to retirement. Well, this is nice. They buy it when they're 32, they let it sit there for 25 years, and then they sell it when they're 65 or 70, when they need the money. Right? They don't need the dividends. There's another reason for that too. I'm 40 years old. I put $200,000 into the stock market. I lost it all. Very sad. But because I'm 40, can I still make it back? Probably. That's a lot different than some guy is 70 and loses $200,000 in the stock market. Because that guy won't be around to make it back. Can you understand why? So this is the type of investment for people that are what? Younger and can take risk. They can recover from the risk. Okay? I mean, they're doing crazy stuff. They're having kids. Yeah. Well, that's pretty risky. Okay. Third type of stock. Value stock. Stock that is cheaply priced, that gives you a good value. Stock that is undervalued, where you know this stock is worth something. I didn't look today, but they announced that new thing for COVID. Right? Big announcement by Pfizer. Okay, what do you think happened to WestJet stock? Did it go up? I would assume so. I would assume that right now airline stock, I would call value stock. I'd be saying, they've had a terrible time. Their stock prices are a joke. An announcement like that might be very good news for an airline. Can you follow? What's it say? Did they go up or down, WestJet?
Yeah, no, they went up last off after upbeat news on the COVID.
How much did it go up by?
Talking about Delta, I saw that.
But it did go up, so our prognosis was correct. So right now, if you wanted to risk a lot of money, if you took $100,000 and bought into airline stock, it's risky, but if COVID ever gets settled, it wouldn't shock me, you tripled your money, right? Because that's value stock. Okay, now common versus preferred stock. Common versus preferred stock. Common stock is ordinary stock. It's what we typically think of. You have an ownership in the firm, and you get voting rights. And you have a right to profits. That's different than preferred stock. Preferred stock you do share in the profits, but at a fixed amount. Your dividends are lower. They're fixed, kind of. They're almost like a bond. And you don't get voting rights. You don't get to vote with preferred stock. But you do have an advantage in bankruptcy. In bankruptcy, the preferred stockholders will be paid first before the common stockholders get paid. So in bankruptcy, preferred stock is good news. But no voting rights, and the dividends you get are kind of fixed. Oh, by the way, forgot to tell you. If there's dividends, before the company can pay the common shareholders, they have to pay the preferred stockholders. They have to be paid before, legally. So start thinking of preferred stock almost like a bond, almost, right? It has a fixed income flow, that kind of thing. And now we're on the last page, maybe the toughest page. And here I want to start talking about diversification and risk. So let's look at risk first. I think we've lucked out. You've got 2 tables already that I'll be going over, so you won't need to squeeze them in on your paper. But you don't have this one. So what you're seeing there is quite a classic diagram that's done in any finance investment course. And it talks about rates of return that you're going to get on investments. So here we have return. So it would be 5%, 6%, 20%, whatever, going up this way. And here's risk. So the first thing you note when you look at that line is the greater the risk, the higher the return. So if I buy a Government of Canada bond, has that got a lot of risk? No. So it has low risk and not that much return. If I do a cocaine deal on the Mexican border, is that a high rate of return? Yes. What about risk? Yeah, big risk. We okay on that? So the riskier you make the investment, the more that your return should be. I use it in real estate and appraisals. If I own an apartment building in Vancouver, here it is. If I own it in Hythe, what did I just tell you? Hythe is pretty risky to own an apartment building. A lot riskier than Vancouver. Vancouver always has people coming in. It'll rent forever. Hythe, I think I'm a young person in Hythe. I think the average age there is about like 78 or 92 or whatever. And it's got a shrinking population, so you're probably going to have a lot of vacancies in your apartment.
So how would the return be bigger on the Hythe?
Okay, Hythe, in Vancouver, maybe the apartment building would yield me 7 or 8%. In Hythe, I'd want to make 15, 20% because it's much riskier. And the riskier it is, the higher the return I want. That okay? So we just talked about, give you another one. Government of Canada bonds are not very risky, are they? Are corporate bonds riskier? They are. So I might accept 4% on the bond from the government, but for a private corporation, I want 8 because it's more risky. We okay? Now notice something the line didn't start here, did it? There's something called return-free, risk-free, and it has zero risk. What's that? That's the Government of Canada bond, or typically in finance, we say that T-bill. Remember that short-term government debt, 90-day? There's no risk. They're going to print the cash for you. You will be paid back the 1,000 or the 20,000, whatever. So that's the risk-free investment. Remember I told you it was the base rate of all interest rates? Here it is. There is a return, but it has zero risk. That's why this line doesn't go to this corner. We okay? Yeah. Okay, now, the risk premium that you should get that's what it is, the risk premium. The premium that you pay that relates to the risk is whatever the investment return is, which you find on that line, minus the T-bill rate. Notice the T-bill is zero risk, so it's here. So if this corporate bond yielded 5%, the T-bill rate was 3%, your risk premium in here would be what? 2%. How's that look? We okay on that? Now, diversification. Very important when you're looking at investments. And next week we'll talk about it more. Your rich uncle just died. So it's a dream. The lawyer's outside there for all three of you right now waiting in his car. And he's going to tell you that all of you got $1 million. Here you are, tax-free. It's an inheritance in Alberta. Okay? You have two choices. Choice A, you buy one stock. Choice B, you buy 20 stocks at $50,000 each. What's the smart move? Which is riskier, A or B? A. You've only bought one stock. It can go up or down or stay the same, but that's risky. You put all your, the term is, eggs in one basket. Far better that you went in to B, put 50,000 into 20 different stocks. Some will go up, some will go down, some will stay the same, but overall you'll be better off. It's less risky. Can everybody follow that idea? And what's going to happen next week, they're going to talk about mutual funds. Well, what's a mutual fund? A bank or a finance outfit has gone in and bought 20 stocks, created a fund, they've diversified for you, and you're going to buy into it. Are we okay there? Yeah. I get it in real estate. So your rich uncle gave you $1 million, should you buy one apartment building in Grand Prairie or 3 apartments? One in Edmonton, one in Grand Prairie, and one in Vancouver. And you'll say, well, how can you do that if the apartments all cost $1 million? You haven't got $3 million. Well, what I do is I put in $333,000 into each of them and get a mortgage for the remainder, which is a smart move. Yeah, don't buy one apartment in Grand Prairie, because if Grand Prairie gets in trouble, you've lost your family fortune. Whereas maybe things are bad in Grand Prairie, but things are good in Edmonton and Vancouver. In fact, I found that a lot of investors, what do? They invest in Ontario and in the West. And typically in this country, when Western Canada's doing good, Ontario's in trouble. And when Ontario, the manufacturing guys, are doing well, we are what? In trouble. So they diversified their risk by having real estate all across the country, right? We okay on the idea of diversification? Yeah. Next, risk tolerance and portfolio allocation. Risk tolerance and portfolio allocation. First thing I want you to note here, stocks are riskier than bonds. You're going to find out, and they'll tell you in the mutual funds, stocks have a lot more risk than bonds. Is that okay? So if I was doing that diagram again, I'd go like this. I'd be putting bonds here, and I'd be putting stocks here. We okay? Back to your age. Which people have a lot of risk tolerance? If I look at investors. Younger investors. Why? Because they can lose it and make it back. So that tells me at this time of your life, if you guys are under 40, now's the time to risk. I'm not going to tell you that. You and I should be doing what?
I know, should.
We shouldn't be, although I know you're very young. You're probably just barely 40, right? Yeah. Okay. You and I should not be doing lots of risk in investing, because we can't make it back. You two are younger people. Take the risk. Don't settle in your investments for stuff that is getting low income, taxable, and then somehow feeling bad when you're 65 and you have no money. Now's the time to do what? Risk a bit. Because you can lose it and you'll still make it back in 10 years. Okay? You can do that because of your age. So your risk tolerance is high. Our risk tolerance is low. So when we're seeing the financial planner, they're picking up on that right away, right? Okay. Now, that brings up the following rule of thumb, and here's what it is. $100 minus your age is equal to the percentage of your portfolio, all the assets you own, that you should have in stocks, because stocks are risky. So let's try that out. You are 30 years old. 30 is pretty young, isn't it, for investors? You should have how much in stock? 70%, because you have a lot of risk tolerance when you're 30. This is when you want to make the big gambles. Can I tell you another one? This is tricky. See if you can figure it out. Remember the accountant told us a registered education savings plan? What kind of assets should we have in it? I would tell you this, risky ones. I do a lot of stock in that because your kids aren't going to take it out for how long? 20 years. Most people are putting money when the child's born. So if that's the case, yeah, risk a bit. You know, you might be pleasantly surprised. If you're not, 5 years from now, what can you do? You can make up for it because they're not going to need it for another 15, right? Okay, you tell me how much, and you work it out using your calculator. You're 50 years old, you're 70 years old. See if you can figure it out. Is that the right answer? Your middle age, 50% in stocks, 50% in bonds. Your 70, what should it be? That's a lot lower. Why? Because you have lower risk tolerance. You haven't got lots of years to make up for losses if that's what happens. Are we okay? Yeah.
Right now with interest rates so low, so you don't have much chance of them going lower for your,
None.
so it's not gonna go higher, the value, but it's not really paying out any return either.
So what you do is you go buy bonds, still fits with the model, but you make sure the maturity is what?
Short.
Very short. I'm in that for like a year and a half, and it's maturing. There's another fancy diagram we can do of what we just talked about. Have a look at that diagram. This looks at the amount of stocks that you have in your overall asset base, your portfolio. What's it telling you? When you first start off work, you're young, boot her up, 70, 80% stocks. You get mid-career, you're around 50 years old, it should be half bonds, half stock. You're retired, maybe start thinking I want 20%, 25% stock, more bond, because it's lower risk. Everybody follow the idea? Yeah. And your point is well taken on interest rates. We're at the bottom of the cycle, so we'll want to make sure these bonds are what? Maturing very shortly, short term. Okay, now we're going to look at something that we should talk about, which is called CAP-M, which is a well-known model, and here again you're in third-year commerce. CAP-M stands for the capital asset pricing model, and I've given you two diagrams of it. Capital asset pricing model. And I'm going to start with this one, and so make some notes on that. Okay? And we'll just have a quick peek at what it means and what it does. This is slightly different than the one you've got. I find it's a bit awkward. They curve it in this way, which I don't like. Okay? So what's this line called? Sometimes a security market line, but they've got capital market line. So it's really about interest rates and risk. Write in the word efficient, markets, hypothesis. So what's the efficient markets hypothesis? Here's what it is. In a stock market, there literally are hundreds of thousands of investors, tens of thousands of security dealers. They're all dealing in information and values of stocks. They're not stupid. So when they price a stock, you get a price of WestJet stock. Someone's used their mind on it and they're betting money on it, so they're careful about it. What's that mean? It means that it's almost impossible to beat the market. You could have made money on WestJet only if you knew that Pfizer would bring out the COVID drug. If they actually kept that quiet, and I'm sure they did, then you wouldn't have made money on WestJet today. Can you understand? WestJet would be efficiently priced with all the information that happened. Now today, Pfizer comes out with a drug, and now that price has been rethought by the market. And now we have a new efficient price for WestJet. So it's almost impossible to beat the market. Sometimes you can because of events that happen that no one knows about. COVID is an event. We never knew that was going to happen 5 years ago. Okay, so there's all these portfolios in here that exist that have certain return risk relationships. There's columns of single stocks or portfolios of 10 stocks. They're all in here. And the best one, the very best one for that level of risk is up here at the top. So all along here, there's columns of portfolios. That whole area is filled in. And the most efficient portfolios, the best portfolios, are found on the efficiency frontier. That's right here. So given the efficient markets hypothesis, this is the best you're going to get. Is that okay? Now, as before, this is returns, 5%, 10, 20, 30%. We have a risk-free return. You know it's the T-bill rate, right? So I draw a line from there, I bring it over here, and I drop it down like this, and I'm going to get a point of tangency. Tangency means two things just touch each other at one point. Where do they touch? Right here. That is, on the efficiency frontier, the highest possible return given that risk. I know that because it just touched when it came in. So it's the highest possible return given the risk. Well, that return is the market return. So the highest return is the return on the portfolio of all the stocks in the market that has been priced efficiently. So if you're in Canada, that's the TSX portfolio. It's every stock that's listed in Toronto. All of it. grouped in the weightings and the returns. And if you hold that return, that portfolio, you get that return. Talk to the guy here on Monday next week. He'll tell you that's an index fund. So he can sell, he's with ATB, a mutual fund that will mirror the return on the TSX exchange. So it's a mutual fund that's probably bought a lot of the different stocks that are listed on TSX. You can get that for the New York Stock Exchange. Same thing, it's an index fund. It goes after the index. In this case, TSX or New York Stock Exchange. Okay? So what that's telling you, it's further than that. Here's what it is. Don't bother messing around buying different portfolios. Only buy 2 assets if you're an investor. Only 2. Buy T-bills and buy an index fund. So if I had T-bills, some T-bills, and the rest was in index fund, that portfolio in Toronto, I'd be located maybe here. Let's call it A. And I'd get that kind of return. And the more I put stocks into the portfolio, I'd end up here. If I had no T-bills, nothing but the index fund, I'd get that. If all I had was T-bills, I'd get that. So that makes investing way easier, doesn't it? That means you go down to the bank, talk to the guy here, be really wise, his name's Jerry, and say, Jerry, why should I talk to you? I know what to buy already. I want T-bills in the index fund. I don't need you. Can you understand the idea? And you know that because of this model. Are we okay with that? Yeah? Okay, now that leads me to the other diagram. It's another CAP-M diagram. And I'll explain to you how it works. It's another type of CAP-M model. But instead of, remember the bottom of that previous diagram, I used standard deviation for risk. Standard deviation is the variance of a stock's prices up and down. And the bigger the variance, the more the risk. So that's how they work out the bottom. Now I'm putting in here something called beta, which is after the Greek letter beta. What's beta? How something varies with the stock market. How something varies with the overall rate of return of the stock market, that index portfolio. Here's a line, here's return. Beta represents risk. Here's the risk-free asset. You know that asset is what? The T-bill rate. So along that line, and now the line is called the security market line. Because another name for stocks and bonds are securities. If I got a yield that had a beta of 1, then whatever that portfolio is, it changes exactly with the index fund, the Toronto Stock Exchange index fund of all the stocks that they have, which really means that's the return on the TSX. That's the index fund. I know it because it has a beta of what? 1. It varies exactly like the index fund does. If I was down here, that type of stock, that portfolio that's getting that return has a beta of 0.5, it's a lot less risky. And therefore it has a lower rate of return. This is, all I bought was bank stock. I took the 5 major banks, bought their stock, that's all I'm buying. Very low risk, right? It's going to have a low beta. Can everybody follow the idea? Maybe right now, I don't know this, airline stock might be what? Maybe it's got a beta of 3. It's highly risky in the COVID environment. Are we okay on that? Okay, now, finally to end up for tonight, I'm going to give you the formula that shows you the rate of return there. Looks very fancy. It's not. You've really had it before. And there it is. So, as an example, if the risk-free rate was 5%, beta was 1. In other words, it's the actual stock market itself. And the market rate in the stock market was 13.5% minus the risk-free rate. What number would I get here? I'd get 13.5%, which you know is the rate of return here. Here's 5%. The difference, 3.5 minus 5 is 8.5%. From here to here is 8.5%. Are we okay on that? Okay, now here's your question. You're buying airplane stock. What's the rate of return that you will demand to buy WestJet? Work it out. You want to buy WestJet, what rate of return do you need? Is that our formula? Anybody get 30.5%? That makes sense? You need a big rate of return or you ain't going to be buying it because it's very risky because it's a beta of 3. It's 3 times riskier than the stock market. We okay? So impress Jerry and tell him you know about beta. What you can do is say, what's the beta of that mutual fund? You're saying, how does that mutual fund vary with the overall stock market? Is it riskier or less risky? We okay? And I think we're done. We're at 9 o'clock. So next week we do mutual funds. We have a financial planner coming in.